Although the Chinese economy grew by about 5.2% in 2023, above government target of around 5%, China's equity markets underperformed its global peers. One of the key drags was the deflationary threat. The GDP deflator fell by about 0.5% year-on-year in 2023, resulting in nominal GDP growth of only 4.6%, below the 5.2% real growth. This 4.6% nominal GDP growth was even lower than the 4.8% nominal growth in 2022, when the Chinese economy was disrupted by the COVID-19 lockdown. Nominal GDP is important in the sense that it's an anchor for the corporate revenue as well as the personal income growth. China kicked off 2024 with another negative shock from the CPI reading, which fell by about 0.8% year-on-year, marking the largest decline since 2009. This again fueled the concern about the lingering disinflation risk. China's weak inflation is a double-edged sword. Externally, China may export this inflation to the rest of the world, allowing the global central banks to ease earlier. However, domestically, the weak inflation reading dampened the sentiment in China's equity markets as well as put additional pressure on renminbi depreciation as expectation for more monetary easing remained high. In my opinion, one of the most important parameters this year for China is whether China is able to get out of the deflation trap. On the positive note, the latest budget 2024 showed China's intent to reflate its economy. China maintained its fiscal deficit target as a percentage of GDP at 3%, unchanged from previous years, signaling a commitment to fiscal discipline amid that constraints. The decision to keep the target unchanged suggests that China is unlikely to pursue aggressive stimulus measures. However, the absolute size of the fiscal deficit target has increased by about 180 billion yuan to 4.06 trillion, surpassing 4 trillion for the first time in history. Based on the targets and 3% deficit to the GDP ratio, a simple calculation shows that the implied nominal GDP size will be around 135 trillion yuan this year. This implies China's aspiration for nominal GDP growth to reach about 7.4%, a significant acceleration from the 4.6% growth observed in 2023. This indicates a strong intent to reflate the economy. As such, we expect China to roll out more policy supports, such as the monetary easing. Looking back at the CPI, the contraction of the CPI in January was mainly attributed to the negative base effect resulting from the Chinese New Year falling in February, which alone dragged the CPI down about 1.1%. The impact of the base effect is expected to continue being a considerable drag at 0.6% in February. Nevertheless, February CPI is likely to return positive for the first time in 5 months due to the support from the Chinese New Year holiday effects. As the base effect diminishes in the second quarter, with the right policy support, we think China's inflation may return to positive, which could alleviate the deflation concern, but the pace of the reflation hinges on the magnitude of China's policy interventions. Let's be patient, waiting for more policy supports from China.